So here's what I'd like to start with. So we've talked about the investment principle. We've talked about the financing principle. There's only one principle left, the dividend principle. To kind of lay the foundation for how I think about dividends, I'm going to make a statement that I think cuts to the core of how this entire session, this part of the session is going to go through. Companies don't have cash. They hold stockholders' cash for them. That's not the way most companies think. Companies think that they have the cash and it's your job as a stockholder to get down on your knees and beg them to give you the cash back. But that's not the way it's supposed to be. So I'm going to start with a position of entitlement. As a stockholder, I'm saying, this is my cash. If you want to hold it, show me. It'd be good if at least for 1 year we played this game, that every company was required to pay all of its earnings out as dividends, all of it, and then required to go to the investors and say, invest some money back, right? Because the power is, the way it's structured is with the company. I as a stockholder have to push for change. Inertia works in their favor. So here's what I'd like to do. Here are the two questions I want to focus on. First is when I look at a company and ask how much cash can this company afford to give back to its stockholders, I'd like to be able to answer that question. Maybe the answer to that is a lot, very little, or nothing. But I want to make sure that I'm coming up with that number rather than trusting the man and say, well, I'll tell you what that number is. And second, I want to look at the two ways of returning cash, which in the US have become increasingly common, which is you can pay dividends or you can buy back stock. And I'll tell you up front that I think that dividends really have never made sense to me as a way of returning cash to stockholders. I'll tell you, do you know the history of why companies pay dividends? In the 1800s, when stocks first were introduced into the market, bonds were already there. Bonds actually predated stocks. That's what investors used to put their money in, is bonds. So when stocks were first issued, you had to attract those bond investors. You know how you attracted them? If you go back and look at the very first little ads they used to run for railroad stocks, the attraction they would offer was, there's a 5 3/4% yield on the stock. So what they wanted to do is people to think about stocks as extensions of bonds. And the reason it doesn't make sense is, what did we say equity was? A residual claim. By having this fixed claim on it, you're in a sense going to create a clash that sooner or later is going to come to the surface. So let's start with some very basic facts about traditional dividends. Yes, go ahead.
In the UK, pension funds don't pay tax on dividend income. Mm-hmm. Is there a pension fund tax benefit in the US?
Pension funds don't pay taxes at all in the US.
Right. So
both dividends and capital gains are passed through. So from a pension fund perspective, there's no tax disadvantage associated with dividends or capital gains. Right? Companies that receive dividends from other companies are allowed to exempt 85% of the dividends for taxes. Right? So one of the things I'll talk about is how the tax laws have ebbed and flowed with dividends. The UK and Australia, actually dividends are tax advantaged relative to capital gains, even at the individual investor level, because when you receive dividends, as a UK investor, you're allowed to offset it by taxes paid by the company. A privilege I don't get in the US. So you could actually argue that in the UK and Australia, you've actually tilted the cash return more towards dividends over buybacks because of the way the tax law is structured. Yes?
There is another little to the hybrids, whereby you deduct the interest at the company, the source company. In Europe, most of the countries, they have regimes that exempt incoming dividends. Luxembourg, United Kingdom, so the dividends, that's another advantage.
So there's a tax issue.
There's zero tax on dividends in many European countries.
Dividends are affected by tax policy. You can make dividend policy kind of move around by changing. So I'm going to focus on the country where I'm most familiar with how taxes have changed over the last 90 years. But start thinking about the regimes you're familiar with, and already you can start to see. Switzerland, for instance, is a nightmare because it's all these different, what are they called, cantons? Each one has I actually once sat down to try to do this, and I said, this is crazy. Who runs a country like this? Right?
It's all after all, they exempt everything.
So let's start with some basic facts about dividends.
Question.
Yes?
By offset, do you mean there's no withholding tax, or what is the
Yeah, basically what happens is, let's say you receive $1,000 as dividends as a UK investor from a company you've invested in. Let's say your tax rate is 30%. You normally pay $300 on that $1,000 as dividends, right? 30%. But if the company has already paid a 35% tax rate, remember dividends come out of after-tax income. You're actually allowed to say, look, the company's already paid $350 in taxes. I owe $300 in taxes, so I don't pay taxes this year. So that's what it means by offset, is what the company has already paid becomes something you can use to offset what you owe in taxes, right? Which is a big advantage. Right? If you ask me to give you a word that describes dividends around the word I would use is sticky. You know what I mean by sticky? You take any company, you look at what it pays in dividends, what it will pay in dividends next year. You know the best predictor of dividends next year is? Look at what they paid last year. That's what sticky is. And in fact, you can see the statistics. Every year what I do is I count the number of companies that increase dividends. That's this light blue line. The number of percent of companies that decrease dividends, that's the purple. And the percent of companies that do nothing to dividends. Every single year. Between 1988 and I could update this to 2015, every single year, more companies do nothing to dividends than increase or decrease dividends. Dividends are sticky. Hold on to that thought, because it's going to be a factor in how much you pay in dividends. Dividends are sticky. Second, dividends tend to follow earnings. So key word is follow. They don't lead. They're not contemporaneous. They follow. What that effectively means, if you have a really good year for earnings, don't expect the dividends to go up that year. 2 good years, maybe. The same thing also applies. If you have a really bad year for earnings, you don't see dividend cuts right away. We haven't seen the full effect of the commodity price drop because it's going to ripple through in 2016 and 2017 and 2018.
That's because they have reserves and all that?
It's because dividends are sticky. It's because you don't like changing dividends. It's inertia. The word that actually has to be used with dividend policy is inertia. You want to do what you've always done, and to get you to change, lots of things have to push you.
Also the market reaction, as John said.
Yeah, but that's circular, right? Even if you did not have a market reaction, there would. So what does the market react to? It reacts to the history of dividends being sticky. So when you cut dividends, you know what the market did? It says these guys must be having a really bad year if they cut dividends. So it's not like the market does it independently of the behavior. Dividends are affected by tax laws, of course. And in the US, you've had 2 years in the last 15 where you could see this play out. Between 1913 and 2003, that's 90 years in the US. If you were an investor and you received dividends, you had to pay the ordinary tax rate on those dividends, whatever you paid in your regular income. But if you had capital gains, you paid a much lower tax rate. So for 90 years in the US, the tax law was tilted away from dividends. So if you received dividends, you paid a big tax problem. Yeah, at least if you're an individual investor. In 2003, you did have a tax law change. This was the first tax reform act of that period. And it did, for the first time in US corporate history, set the tax rate on dividends and the tax rate on capital gains at 15%. That's a big experiment, right? Because when that happens, you are changing the rules on dividends. Right after they did that, Microsoft paid a $33 billion dividend the last quarter of that year. They would never have done that before the tax laws changed. But it didn't make the change was not huge. Again, this inertia affects still key. It's not like companies suddenly doubled their dividends. There was an increase, but it was a small one. That 2003 tax law, I think it was George Bush actually was trying to get it through the Senate, and he did not have enough votes to make it permanent, so it came with a sunset clause. It's actually a very weird clause. That on December 31st, 2012, the entire law would disappear and you'd revert back to what you had pre-2003. The assumption was Congress will do something to fix it. You got 10 years. And guess what Congress did? Nothing. October of 2012 rolls around, and this was called the fiscal cliff. November of 2000, they're still talking. So if you're a company, what do you think is going to happen? Next year, you could go back to dividends being taxed at 40%. Last quarter of 2012, you saw the surge in special dividends, huge special dividends. Las Vegas Sands, for instance, paid a special dividend of $10 billion. Remember I showed you the HDS page for Las Vegas Sands? I know you don't. But who's on top of the page? Sheldon Adelson owned 51.5%. So when I say Las Vegas Sands paid $10 billion, basically that's $5.15 billion going to Sheldon. And why is he doing this? Because he said, I'd rather pay a 15% tax rate now than wait till next year and pay a 40% tax rate. So tax laws affect dividends, and across the world you're going to see these variations. In India, for instance, capital gains historically have been taxed at a 0%. Dividends get taxed at a normal tax rate. Chile, don't even get me started. That's got the most perverse, crazy tax law now because there are all these things that layers of taxes. But any time you change the tax law on dividends, you're going to affect dividend policy. But I'm going to give you the graph, which I think is the most striking graph about dividends in the U.S. 30 years ago, when I took my 35 years ago, I'm going to date this right, when I took my corporate finance class, when we talked about dividends, we talked about dividends. 97% of all cash returned by U.S. companies in 1981 was paid out in the form of dividends. Stock buybacks used to happen, but they were unusual. Sometime in the mid-80s, this trend started to kick in where more and more companies started to return cash in the form of buybacks. Initially, people thought, passing phase, it's going to pass. You keep going, by the time you get to 1998, you can already see that buybacks by the time you get to the last decade are now larger. This is collectively the money returned in buybacks. Last year, twice as much cash was returned in the form of stock buybacks as is paid out in dividends. So I have a question. I mean, obviously, this is no longer a passing phase. This has been happening for like 30 years. What is it in U.S. companies that's pushing them away from conventional dividends into stock buybacks?
Because they believe that the value there.
How can that be true for 33 years in a row, right? You got to up markets, down markets. I mean, I can understand if you had, you know how you can test this? Buyback should be high in years when stock prices are low and they should drop off. It doesn't. It just keeps going up. So it can't be that. Taxes actually, remember the tax laws actually made it better to pay dividends than it used to be. So if there's a tax law story, it actually should be that more dividends were paid post-2003, not less.
It gives you a reinvestment choice in a way. Yes. So whether you stay...
Okay, build on that story. But here's what I want you to think about. That story has always been true. So what's happened since 1985 where you think that story has more... Do you see, you know what I mean? It's true in 65, 45, 25. Something else must have made that reinvestment story, the flexibility you have, become more valuable.
Technology change.
The world is changing, right? And let me explain what I mean by that. 35 years ago, if you asked me to list out 200 US companies with solid markets, predictable revenues, margins that are given, I could have listed them out. Starting with the regulated utilities, but consumer product companies, because they had nice domestic markets that protected it. The world's becoming more uncertain, right? So if today you ask me to list 200 companies with predictable and stable earnings, I'd have a tough time getting to 20. And as you get more uncertain about future earnings, the more you value flexibility. In fact, I told you about my daughter who taught me about poison pills by spitting on her fries. She gave me a great way to think about dividends and buybacks. It was about, she was about 8. I had to drive her to a birthday party. So she gets in the car in the back seat. She was tiny, so she still had to be in the car seat. She straps herself in. She demands, doesn't ask, demands that I change the radio station to Z100. If you live in the New York area, Z100, I think they play the same song all through this. I think it's the same song all through because it's always the same song. Initially, I resist and say, "Can we listen to Billie Holiday?" And she said, "I don't want a holiday. This jazz stuff is too boring. You know, just Z100." Very tough person to fight off. So I said, "Fine, okay, you can listen to Z100." So the movie music comes on. I'm not even listening. And then in the middle of the songs, the DJs start to talk to each other. And I'm usually not listening then too, but then they start talking about hooking up. after 25 years of marriage, to show you how disconnected you get. I had no idea what they were talking about. Then my 8-year-old from the back seat pipes up, trying to explain to me what hooking up is. Now, part of me is in shock that an 8-year-old is telling me this. The other part of me is saying, this is a great way to think about dividends and stock buybacks. Do you see the relationship? When you pay dividends, it's like getting married, in good times and in bad times, for the rest of your life, in sickness and in health, for the rest of your life. That's dividends. Buybacks, I like hooking up. 5 billion, never knew you, nice knowing you, move on, right? Companies don't want to get married anymore, invest. This is a reflection of the world we're in. It's not a passing phase. This is going to spread in other markets as well. It's coming. It's just a question of time. You can pass laws, you can restrict it, but companies are increasingly getting scared of these fixed dividends, and this commodity price shock is just going to make them even more terrified because they see what's happening in companies that got locked in. Say, how do we get out? So dividends are increasingly being displaced by buybacks. So keep those things in mind, because I'm going to give you a framework for assessing whether your company is paying out too much or too little in dividends. Let me start with conventional dividends. Traditional dividends, so not counting the buybacks. There are two ways in which people measure how much a company pays in dividends. The first is to scale the dividends to net income. Dividends divided by net income. So if $60 in dividends, $100 in net income, you have a payout ratio of 60%. You're saying, what's a high payout ratio, what's a low one? On the next page, hopefully I can give you some indication of what that looks like. So the payout ratio looks at what percentage of your earnings gets paid out to investors. Then you got the dividend yield. You're saying, what's the dividend yield? It's the dividend divided by the market cap. That's the dividend per share divided by stock price. What does it measure? It measures the portion of the return on the stock that you're going to get from dividends. Remember we came up with the 9.95% expected return for Disney. The rest has to come from price appreciation. It tells you how much of your return you can count on from dividends. So just to give you a sense of what these numbers look like, I took both global and US companies, and this is going to come 2 posts from now. I'm going to do this for 2015, so if you want, check out my blog in a week or so. I take every one of the 41,889 companies that pays a dividend. That's key. And I'll come back and talk about why I added that qualifier. I compute the payout ratio. And I put up in a distribution. The median payout ratio for both US and global companies is about 30 to 40%. You're saying, what does that even mean? If I show you a company with a 60% payout ratio, I'm already telling you this company pays out more than the typical company. You can say it makes no sense or it makes sense or whatever it is, but at least you have a sense of perspective. What about these companies that pay out more than 100% of their earnings as dividends? Are they crazy? They could be. One is REITs, and why can REITs pay out more than 100%?
They have to.
First, they're required. 85% is the constraint, but they often pay 110 or 120% of earnings. How can they afford to?
Real estate investment.
Real estate investment trusts. These are these special entities that were created in the 70s in the US. They can invest only in real estate, so they're restricting their investing, though they play games with that. They finance like real estate people, so basically but they're required to pay out 85% of their earnings as dividends. So that's part of the REIT condition, because they're not taxed. That's the other thing I forgot. So when REITs make income, it's tax-free. So this is wonderful, but the way the IRS gets you is they force you to pay it all out as dividends so they can tax the guys who get the dividends. But they actually managed to pay more than 100%. Why? It's depreciation, it's real estate. So basically add the depreciation back, they can afford to pay 115% of their earnings as dividends. But if a REIT wants to grow, it actually creates an issue, right? Because if you're paying out all your earnings plus more in cash, the only way you can grow is by either issuing new equity or by borrowing money. But the problem with borrowing, what say the nice feature for REITs was? They pay no taxes. It's a conundrum, because it basically means that the tax advantage of debt is gone, but if you want to grow, you're locked in by this dividend policy. The second group of companies in that more than 100% are companies that are old. You know what we talked about, life cycle? There's a point in your life cycle where it's time for you to shrink, and they're behaving consistently. The third is you have commodity and cyclical companies, and if you just have a bad year, not the kind of year we're talking about because it's catastrophically bad, Well, you say, well, things are going to come back. So I'm saying just because you have a payout ratio greater than 100% doesn't mean you're crazy. It could be that you're being rational given who you are as a company. Those are payout ratios. Now, I also said this was for the companies that did pay dividends. Here's a nice trick question to ask somebody who thinks they know everything about markets. Ask them what the median dividend payout ratio is for a US company. What do you think it is? There are 7,884 companies in my US sample this year. 4,750 of those companies do not pay a dividend. Do not pay a dividend. So what's a median payout ratio? What's the definition of median? 50th percentile, right? If more than 50% of companies don't pay dividends, the median payout ratio for your company, for a US company, is 0. It is what it is. But the reason I'm trying to give you, especially if you're not familiar with the data, when I give you a company that doesn't pay a dividend, what's your first reaction? Oh, it's an unusual company, doesn't pay a dividend. Hey, guess what? It is the median typical. In fact, you should be surprised when you see a company, oh my God, my company actually pays a dividend. So that's a payout ratio. When I do dividend yields, I get it. Yeah, go ahead.
Sorry, just
Yeah.
on your remark on the median company not paying dividends, if you look on a long enough time span, is it because companies tend to give dividends only 1 year out of many, or is it because...
Well, no, that's not it. Because once you start paying dividends, the stickiness sticks in. It comes in. Okay. So the benign explanation for this is if you have lots of young companies in there, you should expect them to pay a dividend. The less benign explanation is, instead of paying dividends, increasingly US companies, when they can pay cash out, are actually buying back stock. So 30 years ago, companies might have been induced to start paying dividends. Now, not even trying. They're just going directly to the buybacks.
Do we know how many companies do that? In the UK, we don't have any companies that do share buybacks.
Technology, it's more the rule than the exception. They just go to buybacks directly. Okay? And the buybacks come and go, right? So if Activision, for instance, did a buyback 4 years ago because they had a really good year in terms of whatever they sold that year, they do the buyback. And then the next year they said, no, this year we don't have cash. So there you can see companies come in and out, but they no longer want to even open the door. So what we're left with are almost legacy companies that end up in the dividend space, which means if you're a pension fund and you're restricted from investing in companies that don't pay dividends in the US, I'm squeezing you into this part of the market that's old, mature, old economy companies, and you're looking around and say, I wish I could have bought Amazon. I wish I could buy Netflix. But that's the nature of a restriction that comes from outside. Now, if you look at dividend yields, what did I say this was? This is the portion of your return that comes from dividends. And the median number for the US right now is about 2%. Actually, let me take that back. Median number is 0%. The median among the companies that pay dividends is 2%. So if you're investing in stocks just to collect dividends, you're not going to get rich, right? You need the price appreciation component. So again, use that as a parameter for what's high, what's low. Apple's dividend yield right now is 3.8%. By dividend yield standards, that's a rich stock in terms of how much you're collecting in dividends. So that's a dividend yield. Again, there are a few companies which have astonishingly high dividend yields. And these are the companies that if you're this old-time lazy value investor, you pick. The search for yield, and this is something John mentioned as well, is I think leading people into places that they should not be going. You know what I mean by the search for yield? Rates are low, you want to make high returns. So you go to these companies that pay 6, 8, 9% dividends. And we talked about making 15% with no risk. Doesn't happen. If you're being offered a 6% dividend yield, there's a surprise waiting to be unpackaged. And it's not going to be a good one. In fact, there's this phenomenon called yieldco in the US where increasingly big utility companies are splitting into a portion that's almost an entire dividend machine. And the rest of the company. So you get to decide, do I want the dividend portion of the company or I want the rest of the company? And those yield, the phenomenon driving the yield curve was the search for yield, was pushing up the prices for these companies to levels that they should not have gone up to. So dividend payout, dividend yield, two ways of measuring dividends. I'm going to give you, again, a very simple way of thinking through this, going back to that life cycle I introduced earlier. It's actually the simplest way to think about dividends. Yeah.
This dividend payout and the
Dividend yield.
yields, in both cases we see the global companies tipping much higher in the...
Because in the US, you have the buyback component.
the
Global
other world is not there right now, the other parts...
Oh, you don't have buyback. It's the same magnitude. You're just starting to see it show up for some European companies. Some countries around the world, you're not allowed to buy back stock. It's still restricted, right? So I think around the world, it's still more traditional dividends. But as I said, change is coming. So one way to think about dividends is to think about where you're in the life cycle. You're a young startup, easy. You shouldn't be returning any cash. As you grow, still easy. You shouldn't be returning any cash still because you have to reinvest to grow. As you start maturing, your capacity to pay dividends opens up. What do you do initially? You go into denial. Denial in what sense? You want to become mature. You say, I'm a growth company. But each year you keep being in denial. What's happening? Your cash is coming in. You could have paid it out. You don't pay it out. So what's happening initially? So when you see growth companies become mature and they're in denial, you're going to see cash balances get bigger and bigger and bigger. What's going to stop it? Somebody's got to step in and say, you guys have too much cash. Give me the cash. That's the ICANN route, right? So basically what he's looking for are companies that don't act their age, that are acting like growth companies when in fact they're mature companies. But the dividend capacity opens up. And the other option you can give them is you don't like to pay dividends because it attracts that dividend clientele who come with their own problems. You buy back stock. Whether your capacity to return cash depends on where you are in the life cycle. So let's look at my companies and look at where they stand, at least in November of 2013. There's Disney, 1.09% dividend yield, 21.58% dividend payout ratio. Look at Vale. Remember I said the attraction of dividend yield? You look at the dividend and say, Vale is a great company. I'm going to take all my money and put it into Vale. They got a nice dividend yield for about 3 months. And of course the dividends had to be cut. Why did they have to be cut? Because you really couldn't afford to pay the dividends anymore. They paid 113% of their earnings in 6 point. They hoped then that it was a passing phase, that they could bounce back, but because prices continue to go down, they had to adjust. Tata Motors, what they paid was very close to their 10-year average. Baidu is a nice company to look at in dividends. There's nothing to look at. There's no dividends, no buybacks. And Deutsche, again, you look at the numbers there. There's danger lurking. 1.92% dividend yield, but 362% payout ratio. Again, they were hoping that earnings would bounce back. And the problem for them was, not only did earnings not bounce back, but they've got a capitalization problem on top of it. And logically, you got to step back and say, something's got to give here. But that's the nature, again, of getting stuck with a dividend policy that it's very difficult to back away from. So I'm going to give you the 3 schools of thought about dividends. They kind of scan the spectrum. There's one school of thought that says, if you have no taxes to worry about, if you get taxed exactly the same way on dividends and capital gains, and companies can go out and raise equity with no flotation or issuance costs, it doesn't matter how much you pay in dividends. Think of why. When you pay too much in dividends, normally you say, well, I can't take projects. But in the world that I described, if you pay too much in dividends, you just issue new shares, and you take those projects anyway. Dividends don't matter. Earlier today, didn't we say something else did not matter?
The debt.
Debt did not matter. That was Miller-Modigliani 1. This is Miller-Modigliani 2. In a Miller-Modigliani world, we could have stopped yesterday, right after the capital budgeting section, because it doesn't matter how much. And before you laugh at that, it actually cuts to the core of a truth, which is if you look at great companies, how do great companies become great? Not by finessing their capital structure, not by optimizing dividend payout, but by taking great investments. You take great investments, I'll forgive you pretty much everything else, right? So Google's capital structure might be suboptimal, its dividend policy might be awful, but you say, I don't care. But if your investments are bad, I don't care how optimized your capital structure is and how good your dividend policy is. So there is a core of truth to the Miller-Modigliani model that is worth thinking about. Pick the great investments first and everything else will follow. But dividends do matter if taxes enter into the picture, or you can't raise stock. And in the old pre-2003 in the US, there was actually a fairly big school of thought that said companies should stop paying dividends altogether because of the tax disadvantage. I mean, at its height, I think in 1981, you paid a 70% tax rate on dividends. That was the highest ordinary tax rate, and a 28% tax rate on capital gains. It's almost like a no-brainer. So that's a dividends are bad school. So you have the dividends don't matter, dividends are bad. Let's complete the process. There's actually a school of thought that says dividends are good. On what basis? There are people out there who like dividends, pension funds, older investors. It's like the customer is always right in marketing. The investor is always right. So if your investors like dividends, pay them more. This is extremely convenient if you're a CFO, because there's a whole school of thought backing you no matter what you do. You increase dividends, you point to the dividends are good school. You cut dividends, you say the dividends are bad school. You have no idea what you're doing with dividends, you claim to be in the Miller-Modigliani school. There is a core of truth though in all of these. Yes?
Just a question. I mean, all these investors were super fans of dividends.
Yeah.
To me, I mean, from the investor point of view, assuming no tax advantage, they kind of what you see is the adjustment at the dividend date. And the end of the day, there's no effect on the share price.
So you're saying, why do people get so psychologically attached to dividends? Lots of reasons. Behavioral, right? You get a check every 3 months in the mail that says you made $300 in the stock.
The stock was dropped by this $100.
Well, you don't even care because the price drop is not, it's on a paper statement somewhere. This is cash. You can take it to the grocery store. You can endorse it to your child. So one is behavioral. People like to get cash. The second is these are people who think of stocks as extensions of bonds. When you buy a bond, do you ever think about the bond price? Normally you say, I'm collecting the coupon. That's what I bought the bond for. So are they being rational? It's not even a question of rationality. That's what drives their process. And I'll tell you why an insurance company or a pension fund might like this. If you're an insurance company, when you invest, what do you have to make sure you cover? That you have enough cash flows to cover your liability. So in a sense, you got a liability stream coming. You need cash flows to cover them. You don't want to be selling stock at the wrong times. The advantage to them with a dividend-based company is they can actually plan the cash flows. They know what's coming. It makes them... So there are some good reasons why people like dividends. Maybe they're over-attached to them. But if that's the kind of investor you attracted as a company, if you like it or not, you got to keep feeding the frenzy. So those are the three schools, and so I'm going to suggest to you that a very compressed version of how I think about dividends. It's very simplistic. If your company has lots of cash flows coming in and not very many good investments, you should be thinking about giving cash back to the stockholders. Does that sound reasonable to you? Or on the other hand, you don't have very much cash coming in, you have lots of investments, don't give cash back to the stockholders. This isn't rocket science. So I'm going to go through two ways of determining how much a company should pay in dividends. One is very similar to the capital structure approach, the Me Too approach, which is how much should you pay in dividends? Look around you, look at what everybody else is doing, do it. But I'm also going to go through an intrinsic way, which is I'm going to try to assess how much you could afford to pay in dividends, how much you actually pay, and then I'm going to say either you're okay, you should pay more, or you should pay less. So here are the three questions that drive how I think about dividend policy. The first question I'm going to ask you as a company is how much could your company have paid in dividends over the last 5 years, last 10 years? I'm going to call this potential dividend. Sounds fancy, but it's going to be a very simplistic calculation. It's very, very intuitive actually. I call it free cash flow to equity, but it's just potential dividend. What could you have paid out? Then I'm going to compare to what you actually return in dividends and buybacks. And then for those companies that have paid out less than they could have, I'm going to ask the final question. Do I trust you with my cash? Who's you? You're the company. I'm the stockholder. And if the answer is I do trust you, guess what? I'm going to let you accumulate my cash. Cash by itself has never ever hurt an investor in a company. It's what you do with the cash that could do serious damage to me. So if I trust you, I'm going to let you hold 30, 50, 80, $200 billion of my cash. If I don't trust you, guess what I'm going to do? So I want my money back. It's my money, and if you accuse me of being greedy for wanting my money back, that's your problem, not mine. This is my money, and that's why I said the core of this is to think of cash as belonging to stockholders and companies holding on to them. So let's start with the first question. How much has the company returned? Let's start with the easy one. As I said, there are two ways you can return cash, dividends and buybacks. So for each of my 5 companies, I looked at how much they returned. So if you look at Disney, during the 5 years that I looked at them, they had $4.5 billion in dividends. That's about $900 million. That's a lot of dividends, right? But look at how much they bought back in stock. $15.4 billion of stock. Collectively, they returned almost $20 billion of cash over those 5 years. If you look at Vale, $23.9 billion. These are all US dollar numbers, so they're not even inflated by using nominal real numbers. Huge dividends. Why? Go back to the first day. What did I say? Most Brazilian companies have common and preferred shares, voting and non-voting shares. And you made a pact with the devil, right? With those non-voting shares, he said, I'm not going to give you voting rights, but in return, I'll pay these big dividends to you. And if you don't pay the dividends, guess what happens? They get the voting rights. Okay? Okay? And this goes back to what I said the first day. Do you want to control a company into bankruptcy, which is what Vale is going to be on the process of doing if they keep, because many of these, at least for Vale and Petrobras, to me the solution seems simple. Go to the non-voting shareholders and say, we're willing to offer you a deal, and it's a deal from the devil, but you have really no choice. They're not going to like it. So we have to cut dividends, and we'll give you voting rights instead. Do you think the Brazilian government will go along? Not unless they get truly desperate. Things are getting to a point where they might have to go around, but they have no choice. But that's at the core, I think, of many, and it's not just the government-controlled companies. Many Brazilian companies, the old-time companies, especially as the Brazilian crisis unfolds, are going to face this problem in spades. They have to decide for themselves whether they'd rather give up control and go back to health, or go through the cycle of destruction of value, paying out too much in dividends and borrowing money to cover it, and digging themselves even deeper, and hoping that the economy kind of comes back and saves them. So that's how much they return. And you can see Tata Motors and Baidu and Deutsche don't buy back any stock. It's all dividends. Yes?
If you live in an economy where people's perception of dividend is they expect it to pay annually. I mean, why people actually go to invest in that? They need dividends from.
Yeah, this goes back to us. If you're dependent on the cash flows from dividends, then you have to pay dividends, right?
Okay. I was just going to ask, how do you think that's going to affect the market value of shares?
Oh, absolutely. It will affect the market value of shares. But here's the question. What if you're paying dividends you can't afford to pay? Right? In other words, you're paying the dividend because investors are going to be disappointed if you don't. But what if you're getting deeper and deeper into trouble as a company just to keep the dividend stream going? Somewhere along the way, you got to face up to the reality that oil prices have gone to $27 and you can't keep doing what you did when oil price was 60. That's, I think, the moment of reckoning when you say, okay, I've got to give up on that. Investors are going to be really disappointed when that happens, but I see no choice. It is reality staring you in the face. So that's the total demand. Yeah.
The governance question.
Yeah.
What actually happens to a voting right when you buy back?
No, what happens is here's what happens. When you buy back shares, those shares are destroyed.
Oh, they're
taken off the book. So you can't keep it. You can't play these games like treasury stock. I'll keep it on because for the simple reason of corporate governance, because you can't have these voting rights sitting in the company with somebody else controlling them. So what happens is that remaining shareholders now own a bigger percentage of the company. So you have the same voting right, but your voting right is now a bigger percentage of the outstanding shares. So that's the first stop. How much did the company return? Second stop, how much could you have returned? And it's actually very easy to compute if you have access to the statement of cash flows. Right? Every company, there's an income statement, balance sheet, statement of cash flows. The statement of cash flows is the most honest accounting statement of the three, right? It's as close to honesty as you're going to get. There's no, because it's cash in, cash out. If you go to the statement of cash flows, here's how you compute how much your company could have paid in dividends. You start with the net income. That's the top line. You add back depreciation and amortization. Remember why we do that. It's non-cash expense. And then you start writing check after check after check after check for every person you got to pay. Like what? Well, if you have preferred dividends, that leaves the company. Capital expenditures, cash outflow. Working capital goes up, cash outflow. See what I'm trying to do? I'm starting with the cash flow. So how much? And if I borrow money, this is one of the few bonuses I get, cash comes in. And then I look at what I have left at the bottom after all these adjustments, what's called the free cash flow equity. Potential dividend. So if you have a statement of cash flows, you can compute what your company could have paid in dividends last year, 2 years out, 3 years out, so basically as many years. So you measure what they could have paid, what they actually paid. Could that number be negative for a company making money? Yeah. But 35% of all US companies that make money, by the time you work through the adjustments, their free cash flow equity is negative. Let's make dividend policy really simple. If your free cash flow equity is negative, how much can you afford to pay in dividends? Zero. First rule in being in a hole is stop digging. If your cash flow is already negative, what the hell are you doing making it more negative by paying a dividend? So this to me is the central, it's that lever that lets me understand how much my company can pay in dividends. So I tried this for Disney. I took 2008 through 2012. I computed the free cash flow equity. So basically that's how much they can afford to pay in dividends collectively over the 5 years, because free cash flow equity tends to jump up and down because of capex and reinvestment. They could have paid $18 billion in dividends. That $18 billion is based on assuming that they're not fixing the debt. They actually, during these 5 years, they actually went out and borrowed more and more. So they actually had $27 billion in cash, with $9 billion of that coming from pushing the debt ratio, which actually is not a bad thing for them to do, right? Why? Because when we did the optimal debt ratio, it looks like they have debt capacity. So at least in theory, they could have returned $27 billion if you count the debt. But if you want to be conservative and say that's temporary, I can't keep paying that out, they could still pay $18 billion. They paid about $19.9 billion. So if you were looking at Bob Iger over this 5-year period, clearly the policy here is to give cash back to the stockholders. Is that good? Is that bad? We'll come back to it. But at least you get to see that by looking at these numbers. Now, can you do a free cash flow equity for a bank? You can if you think about that regulatory capital as your reinvestment. If you go capex, depreciation, working capital, you're going to get lost really quickly. But to me, what a bank can afford to pay out in dividend is the net income minus whatever you have to invest in regulatory capital in order to grow. And what's going to determine how much you have to invest in regulatory capital? One is we are a growing bank, obviously you have to invest more. The second is we are an undercapitalized growing bank, then you got to. So when I do this for a money center bank, I'm projecting out what they can afford to pay out given their regulatory capital standing. And I might conclude that for this bank, free cash flows equity are negative for the next 5 years. So I have two signals coming, right? If I look at the actual dividend, says positive, positive, positive. If I look at the potential dividend saying negative, 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 and in valuation, I'm going to go with the cash flow. You're saying, but you get the dividend. I'm getting the dividend, but they're issuing shares on the other side. What I'm not missing there is the dilution that's going. The free cash flow equity is a much more honest way of thinking about what a company can do. And you can do it for a financial service company, a manufacturing company, a retail company. Your objective is to estimate what the company can afford to pay out. So here's what the world looked like in 2014. And again, this will be my final update. When I do the update this year, I'll do the 2015 update. So I'm going to break the world. This was about 40,000 companies last year. I broke the world down into 5 groups. With each group, tell me whether this group is doing the sensible thing. The dark blue are companies which have negative free cash flows to equity and pay no dividends. Make sense? Okay, that's good. Second group, the green, is companies with negative free cash flow to equity that pay dividends. No? At least I'm going to take a second look at them. Maybe they have a really good reason for this, but they're clearly not acting the way I would expect them to. The third group of companies are companies where the free cash flow equity is positive, And they pay dividends, but the dividends are less than the free cash flow equity. So what are they doing? They're building up cash balances. And if they have a really good reason and I trust them, I'm going to be okay with it. If not, we're going to have a problem. The fourth group of companies are free cash flows equity which are greater than zero and they pay no dividends. These are building up cash even more. Again, I'm going to look at what they do and say, do I trust them with my cash? The last group of companies are like the second group. They have positive free cash flow equity, but they actually pay out more than that free cash flow equity as dividends. So the second and the fifth group are paying out more than they can afford to.
The third group is paying out more than
not just the labels.
Or maybe I got the labeling wrong. I'll check this because one of these is, so this group is actually doing the sensible thing, this group is not, so the purple, that's better actually, the fewer crazy clumps. Let's make the third group. But the reason I break it down by region is this year when I do it, Australia and Canada are going to have a lot of crazy looking numbers. You know why? A lot of natural resource companies. A lot of natural resource companies this year are going to be like the last place in hell, the last stop in hell in terms of dividend policy because of the free cash flow equity. He's been given 5% of Aramco as a gift, so. So that's yeah, go ahead. The what? The previous slide?
The other one, next. What? At the bottom?
Yeah. Oh, that's actually, if you remember the project workbook that you got this that just tells you what page in the project workbook you can get numbers that you will use on your project. So when you're working through on your project 3 weeks from now, you'll have forgotten this class altogether. This is you know what, there are 3 more packets. So that'll tell you where to go. So hopefully that will help you as you work through the project. So that's it. So in the project you can actually do this if using that very last page. You can do the statement of cash flows and free cash flow equity, the potential dividends for your company, and see what it actually does pay out.
Dividend we'll also get from the annual report.
Dividends though, just go to the statement of cash flows. You know why? Because you're going to get things like stock dividends, things which are not dividends. These are little tricks that companies where we can't afford to pay the dividend. Oh, here I have a stock dividend. We should slap them around the face and say, I don't want that because everybody gets it. So stock dividends are kind of this useless gift, right? Because it's like a stock split. You have twice as many shares. Who cares? Everybody has twice as many shares. So that's why you want to go to the statement of cash flows. It actually tells you what cash was paid out as dividends. So you can go to the annual report. Some companies that might be enough.
I was just asking, the handout that you've given, that doesn't have this.
It does.
It will.
On the very last page, the FA page actually has the dividends from the statement of cash flows. So here's the framework we're going to use to analyze dividend policy. I'm going to compare what you paid out to what you could have paid out. One of 3 things is going to be true again. Either you're one of those companies that pays out roughly what you can afford to as dividends. 98%, 99%. Utilities in the US are very good about almost returning every last dollar of free cash flow equity back to investors. That's the nature of the game they play. But let's look at the other 2 scenarios. You could be a company that pays out too much in dividends or too little in dividends. If you're a company that pays out too little in dividends, that 5th group, you're going to be starting to build up a cash balance, right? Then I'm going to stop and ask you, do I trust you with the cash? I won't even ask you. I'm going to ask myself, do I trust these guys with my cash? Because if I ask you, can I trust you with my cash? It's kind of a stupid question. You say, of course. So I'm going to look at your history. And what am I going to look at? I'm going to look at whether you picked good projects in the past. And for that, what am I going to do? I'm going to look at your return on capital. Everything has its place. It kind of feeds back in. And I'm also going to look at your Jensen's alpha. If you ruined my stock, knocked it down 50%, you've been taking bad projects, I'm going to say, I want my cash back. You're going to complain and say, I've changed, I'm a new leaf. I don't care, I want my cash back. If you have a good history, you're going to get the privilege, the right to accumulate cash. No company has the right to accumulate cash. You earn that right by delivering good results. So that's if you're holding back cash. Now let's look at companies that are paying out more than they can afford to in dividends. Question I'm going to ask you is, do you have good investments? You say, why do I care? I'm just paying out dividends. Because when you pay out too much in dividends, what's happening? Cash that could have gone into the business is now being paid out. If you're a company with good investments that's paying out too much in dividends, you're doing double damage to yourself. Not only are you getting a cash deficit, you're not taking investments you otherwise should have. So there I'm going to push you to cut dividends. And if you're a company with bad investments and a dividend problem, you're like a person who's sick and you go to the doctor and the doctor says you're really sick. Really, really sick. And you say, I'd like a second opinion. He takes another look at you and says, you're really ugly too. This is a company, there's no redeeming feature to it. There's a dividend problem, but the dividend problem is coming from a bad investment problem. You're afraid if you cut dividends at Glencore, that they'll find a way to do crazy things with that cash. So this is a company where the core problem is deeper. It's an operating problem that's manifested itself as a dividend problem. That to me is what's happening in commodity companies. You know, it's $27 oil prices, okay? But there are all these investments they've taken over the last 10 years on the expectation that oil price will be 80, that shale oil investment you might have made. That requires a $75 oil price to break even. It's not going to go away when you cut dividends, it's still there. That's what's going to make this a very difficult problem to solve. It's not just cut dividends, everything's going to be okay. There are core investments that are going to keep these companies down essentially for a very long time period. So that's the matrix I think about. When I think about a company, I plot it on a matrix. And here are the two axes in the matrix. I look to see whether you have good projects or bad projects, looking at your history. I look to see whether you're building up cash, which means if you're paying out less than your free cash to equities dividends, or whether you're paying out too much in dividends. And here's your most flexible scenario. Most flexible in the sense, if you're management of a company, you want incredible flexibility, earn it. You take good projects, I'm going to give you the right to accumulate cash. I haven't heard or read a single equity research report that has complained about Google having too much cash. Do they have a lot of cash? Yes. I've had lots of earnings equity research reports as well as investor reports that complain about how much cash HP has. And HP has like $2 billion. See, this is not fair. Google has $80 billion. Nobody's complaining about it. HP has $2 billion. Apple actually is an interesting company because when you started this game in 2009, nobody was complaining. You get to 2010, 2011, all of a sudden people are... So this is not a permanent... So the longer Apple went from its latest disruption, the more pressure is building up, because for a while after the iPad, people said, well, there's another thing coming, because they were so used to it over the last decade. Every 3 years, you're going to get a blockbuster product that creates $100 billion. So for the last 6 years, if you look at every report, is this the one I watch, will it do it? So essentially with Apple, I think that the longer you go from a big disruption, the more pressure there is to return cash. No? And that's, I think, the nature of this process. You don't get a permanent license to accumulate cash. There's a point in time where investors start to lose patience and say, I want my cash back. Question? Yeah?
When tomorrow comes and you need to raise capital for existing shareholders,
right?
What in your experience or study will be more relevant in determining whether the right issue will be successful or not?
Well, what your stock price has done. The biggest single factor is how well has your stock done over the last if your stock has gone up 50% over the last 5 years, when you make that rights issue, first, on a rights issue, it's silly for anybody not to exercise the rights, because if you don't exercise the rights issue, what happens? You've given up. Because the rights issue by definition is always below the stock price, right? So basically, if you make a rights issue, it has to be at a discount. If you're making rights issues at the current price, you're asking for trouble. So you do it at a discount because you want everybody to exercise those rights. But whether they exercise will be a function of whether they think your stock is an attractive stock, which is driven by prices, not by dividends. So now let's put this into play, because those are the stocks which companies with the most flexibility. If you've taken poor projects, there's going to be pressure building up on you. That's the HP problem. They've had the two big acquisitions, $8 billion mistakes, coming back to bite you. If you have a cash deficit and poor projects, which is where I think the commodity companies are, you're in serious trouble because there's no easy path up, right? And finally, if you have a cash deficit and good projects, much more fixable, but you still have a lot of people who are pissed off at you. after you've done it. So what I'm going to do is I'm going to take you through 5 cases. Very simple cases. And I know you guys are tired, but I'm going to play the role of the CEO of each of these companies. And you can be the stockholders. And here's the fun part. You can tell me no. So I'm going to beg you, can I keep your cash? And based on what I tell you about these companies, then no way. Or you can say, of course. So let me start with Disney in 2003. Who am I? The CEO, but who was the CEO in 2003? Michael Eisner. What's my history with you guys?
Not good.
That I've treated you like dirt for 17 years. I remind CEOs, in the good times, be nice to your stockholders because there will be bad times. But I treated you with contempt. Remember that. That's going to play a role in whether you trust me. So I get up there and I tell you what I've done. And I have this version of Tourette's where I tell the truth now. Right? So here's what it is. I tell you, between 94 and 2003, I could have paid you $969 million a year. I paid you only $639. So already, what can I tell you? What do you know about the cash balance I built up? That's $330 million every year for 10 years with interest. So that's about a $4 billion cash balance. Right there. Cash balances on companies are not manna from heaven that pop up. They're the direct consequence of not paying us. So I have $4 billion cash. So that's what I am holding of your cash. And I want to do what? I want to keep the cash. So I tell you what I've done as a manager over the last 2 years. And this is where the Tourette's kicks in. I can't stop myself. I can't stop from telling the truth. I said, over the last 10 years, I've taken terrible projects. My return on equity has been about 2% lower than the cost of equity. Oh, not only that, your stock, it's done awfully over the last 10 years. It's delivered about 3% less than the peer group over the last 10 years. Oh, by the way, all of this was triggered because of that big acquisition I did in '96 of Cap Cities, which I told you was going to pay off, but hasn't. Now let me ask you a question. Would you trust me with your cash?
I want my cash back.
Oh, you want your cash back, and it's your right. And think of how many companies around the world, this is exactly where if you ask stockholders, was it 55% of companies? 35% of those companies, if stockholders had a choice, they would go in and clean out the checking account of the company. Every last penny, let me take it out. You're not trusting me, not because I'm Disney, but because of the fact that I'm bringing a track record to the table that is making you look and say, I don't trust you with my cash. And here's where my abrasive history is also going to work against me. Cut me some slack, maybe for a nicer guy. But you remember those old days. When you asked that question in '95, when I was at the peak of my powers, and I said, shut up and sit down. Now it's going to come back. I've lost my freedom to accumulate cash, partly because of my history at the company and partly because of the way I've treated my shareholders. Let's move forward. 2009, I'm now Bob Iger. I made some significant changes. Remember, the board of directors has become smaller and more responsive. My stock price has done well. My Jensen's alpha is back to being positive. My return on capital is now above my cost of capital. And I've been returning all the cash that I've made back to you. In fact, my cash return is actually exceeding my free cash. I'm actually returning every dollar of cash and more simply because I'm the anti-Eisner. But now I want to kind of recalibrate and go back to investing. I want to build that new theme park in Hong Kong because 2009 it was on the drawing board. I want to buy Lucasfilms. I want to buy Marvel. So I come back and say, you know what? I know that I've returned a lot of cash to you. But I'd like to kind of go back to a more restrained cash return policy because I'd like to take projects. No guarantees, but are my chances better now that different CEO, different industry? No, it's not going to be unanimous, but you can see why my odds improve if I bring a better track record to the table. When you see CEOs complain about how greedy stockholders are, and I listen to these guys all the time, they talk about, oh, these guys are greedy, they want cash back. You say, what's greedy about it? That's their cash. They want it back because they don't trust you guys. This has nothing to do with greediness across the board because clearly some companies are okay with cash being accumulated. This company, your company, they don't trust you. And as a final twist, let's take Disney in 2013. Between 2008 and 2013, Disney returned to cash accumulation. They started building up a cash balance again. They continue to earn a return on capital above the cost of capital. They made good investments. Marvel, Star Wars. Now, Bob Iger comes and says, will you let me hold more cash? Again, your position is stronger the longer you can keep doing it. But ESPN to me is going to be the big test for Bob Iger. Because if ESPN, as we said, starts to melt down, it's going to take Disney down with it. So how he manages that part of the transition is going to determine whether he gets the freedom to accumulate cash in the future. Steak Valley. How much free cash flow equity did they have before that? Minus 1.9 billion. Well, they did borrow money, which allowed them to actually get to $1 billion. How much did they return? 37 billion. This is, you don't even need, there's something, you have $1 billion return, you're returning $37 billion. You're really digging a deep hole for yourself. And this is what goes back to that control issue, which is both Vale and Petrobras have locked themselves into paying dividends that they can't afford to. And if you're a non-voting shareholder, which is what most of us are in Vale, and I come and say, you know what guys, I can't afford to pay a dividend, the logical thing for you to say is, okay, but give me voting rights. And you got to decide what matters more to you. Yeah?
Is there anything these companies can do with reverse stock splits?
Stock splits do nothing for your company, right?
Reverse.
It doesn't matter. Like doing gymnastics on tower, there's nothing that's changed. The number of units. So all it does is makes your stock look higher priced. But who are you fooling? Just like stock splits don't make me own more shares, reverse stock splits didn't increase my price. When I look at my statement next month, I have half as many shares as I did, selling at twice as much the price. Unless my math skills have become so atrophied that I just look at the price and forget the number of units. So when people, in fact, I'll make a statement. When companies spend a lot of time in stock splits and reverse stock splits, their best days are behind them. This is the kind of gymnastics you do. I'll tell you, the only condition reverse stock splits make sense is if your stock prices drop to a point where the transaction, because if you drop below $1, there's a bid-ask spread starts to, so there's a transactions cost motive. That's the only legitimate motive that I can think of for a reverse stock split that might actually fix some problem, but it's not going to fix this problem. Because you still have this huge dividend you're paying, unless you do I see what you're saying, you do a reverse stock split, but tell them that the per share dividend is going to stay the same. Come on, I'm a non-voting shareholder. I've been screwed over enough. You try that on me, I'm going to say that's nice, but I want the dividend to double. And so there's no easy way out. Contractually, I think if they try to mess with this, they have to give up voting rights.
Professor?
Yes?
Sorry, if I could go back to the Disney scenario on ESPN. Do you think they're keeping that because of its earnings contribution or of its equity contribution?
I'll tell you what, it's a cash cow that feeds Disney right now. It's really, if you spin off ESPN and make it a separate business, you're getting rid of the cash cow that allows you to do all this. The Shanghai theme park is being built by ESPN. That's one way to think about it. It's that subsidy part, right? So there's no easy way for them to let go. Okay? So it's not. My son works at Disney, and so I have a personal interest that they do the right thing. I'm a stockholder in Disney. I want them to do the right thing. But this is one of those cases where I think it has to be I think it's ESPN that has to fix the problem. They've got to untie that cord that ties them to cable. What did do any of you have HBO? It used to be in the US that to watch HBO on the go on your device, you needed a cable. You need to be subscriber to cable. But HBO I think HBO on the go, is that what it's called? You can now pay $10 a month directly to HBO. And you see what that HBO did, right? They said, look, we can't, and ESPN has to do it. The only problem is they get so much cash from cable that this is not an easy thing for them to do. But I don't see any way in which they can not do that at some point in time. And maybe it's better to do it earlier rather than later. And offer an ESPN as a separate stream.
Yeah.
And they have the bargaining position with cable that they might be able to have their cake and eat it too. Maybe a lesser version of ESPN, maybe not get all the things you get, but I think they have to think about doing it. Let's talk about BP. I used to do a training program for BP 25 years ago. I stopped doing it very soon. It was one of the strangest training sessions I used to do. They used to fly in 12 of their top petroleum engineers from all over the world into a room in London. And they would turn them over to me and say, teach them all the corporate finance they need to know in 2 days. And actually it wasn't difficult because these guys were really good with numbers. And after a while they said, this is all corporate finances, this is what we've been intimidated by for like 20 years. So as part of that process, I would take BP apart in the class because the company they obviously clearly understood. So the first time I looked at BP's dividend policy, I thought I'd screwed up. Let me explain why. This was between 1982 and 91. BP had a free cash flow equity of $571 million. It's pretty hip. Now how much dividends can a company with $571 million in free cash flow equity pay out? $571 million. They managed to pay $1.6 billion every year. Every year. You're paying out $1 billion more in dividends year after year after year. Do you think it's a problem? Of course it's a problem. Everybody knew it was a problem at BP, including the janitor. You know how? When he wanted a new broom, the company said, no, not this year. We need the cash to pay dividends. This company had a dividend problem that persisted all through the 10 years. So why didn't they do something about it sooner? Let's go back to 1987 and they could have done something. Meeting of BP top managers. Somebody pounds the table. Oh boy, we have a dividend problem. My Oxbridge is not that good. Aye, everybody around the table agrees there's a dividend problem. Cut dividends. Oh yeah, brilliant idea. Until somebody asks the key question, which is, who's going to tell the stockholders? You say, so why can't you tell the stockholders? You can't afford to pay the dividends. Well, what I said, you get the investors you deserve. You pay small dividends, you get investors who like small dividends. No dividends, you get investors who like no dividends. Big dividends, you get investors who like big dividends. Obscene dividends, you get dividend addicts. And in this 10-year period, I think BP accumulated the strangest, weirdest group of people ever called investors in a publicly traded company. Every dividend addict in the world was in that room. And what are you going to tell these addicts? I'm going to cut your dividends. No way, right? So you go back to the meeting, all of a sudden people say, I don't think I'll be at the meeting. I think I'm going to have laryngitis. This meeting's 6 months away. And after a while, you of course have this one facilitator at every meeting who says, let's wait, maybe something good will happen. Which for an oil company is what? Maybe oil prices will go back up, our dividend problem will go away. For a brief period in 91, when Saddam Hussein invaded Kuwait and oil prices spiked for a little while, you could almost see BP managers dancing on the desk. No more dividend problem, no more dividend problem. Of course it came back again. Finally in 92, they cut dividends. You think they did the right thing. Somebody at the cut. You know why they cut dividends? Every year for 10 years. You know how BP came up with the extra $1 billion? They borrowed the money. BP by 92 was the most highly levered oil company in the world. So when they went in 92 to try to borrow dividends again to pay, borrow money to pay dividends, the bank said, no. And just to show you there's no just in the world, this is what John was talking about. When they cut dividends, there's not applause, but the stock price collapsed. For this case, I think it was 3.5 months of absolute turmoil. What was happening? Those dividend addicts were all leaving the room. And along the way, they kind of panicked and took half the top management team with them. They stampeded. That's what happened when you have dividend changes. It's never pretty. Managers are going to lose their jobs. Now you see why nobody wants to mess with dividends. It takes, everybody can look at a company and say, obviously this company should cut dividends. That's what we're saying with a lot of commodity companies. But if you go inside the company and say, why aren't they doing it? The answer is very simple. The messenger is almost always going to die after delivering this message. No wonder companies get locked into dividend policies they can't afford. Which brings me to my final company. It's a limited. Actually, it's fourth of my five. Limited. Free cash flow to equity minus 34 million. This was actually when it was a high growth retail company. Again, if I ask you how much can it pay out in dividends, the answer is nothing. Then I'm going to give you the story that probably got them started on paying dividends. Early in this process, you're the limited, I'm an investment banker, I show up in your office and say, look guys, you should pay a dividend. Because if you don't pay a dividend, there are all these people who can't hold your shares, these pension funds, etc. Now initially push back saying, I can't afford it, I have negative free cash flow to equity. He said, just pay a small dividend, a token dividend. It's alluring, right? You pay a token dividend, you get on their list, maybe they'll buy your stock. What's the problem with that advice? How do I describe these investors who love dividends? Addicts. Have you ever offered an addict a token? Have a little cocaine, but please stop. It doesn't work. You have an addict, you give a little cocaine, the next thing I want more cocaine. You give a dividend addict a little dividend, say, no, just stop right now. You know what they're going to do? Next year, they're going to I want more dividends. That's exactly what happened in the limit. The first year they started dividends, they paid $1 million. By the 10th year, they were paying $101 million in dividends. So my advice to you if you're a young growth company is don't go looking for trouble. There are enough investors in this market who will buy your shares even though you don't pay a dividend, and they're the investors who write for you. You attract a clientele that's not suited to you as a company. Nothing good can come out of this. You're a company that can't afford to pay a dividend, you don't want to attract people who want dividends into the game. Yeah?
What a question. Suppose you don't have shareholders but members, and we do have those addicts, when we found this. So now
well,
we're thinking about to give them back, but at the margin.
And so basically it's coming at the expense of the products and services you can offer them, right? Because you have a choice. As a co-op, some of that money could go back into your co-op, make yourself, and in a sense, the clientele you have, because they're both stockholders and consumers, if they're pushing for dividends, are essentially saying, we'll settle for less attractive products and services if you give us a bigger dividend.
Yeah, if we look into their eyes.
Right.
If we
look into their eyes, is that what you said? Okay.
But if we put ourselves in the position, if we play at the margin,
right,
it's going to be before tax for them.
Yeah.
It's better.
Yeah, and so taxes drive their choices. So you can see why they do what they do. And unfortunately, you have to play the cards you were dealt, not the cards you wished you were dealt. And in this case, you've been dealt a group of people who want the dividends. There are things, so it is going to be frustrating for you inside the co-op because you can see all these things you'd like to do with the money. But the reality is, and that's why you often have co-ops do in the US, a lot of co-ops did the switch into public companies precisely for that reason, because many of them got tired of being squeezed by members who wanted, and this was the worst thing, they wanted their cake so they wanted the dividend. And then they complained about the fact that the products and services they were being offered were not as good as they should be. Right? And that goes back to that first, what we talked about the first day. When you have a mixed mission, that's going to become an issue at some point in time. Tata Motors. Yes, John.
You can touch on the earnings accretion of share buybacks versus dividends.
There is an earnings accretion effect because you have fewer shares outstanding. By itself, from a valuation perspective, it has no effect on value. So what happens is if it's a buyback, that's not changing the value of your business. All it means is the portion of your returns now that come from price appreciation go up. So what it offers investors a choice. Would you rather get a dividend and a smaller price appreciation, or would you rather just settle for the... So it's almost like you let people pick what they want.
But if the share price is unchanged,
right,
and you initiate the share buyback,
right,
it's accretive to the earnings multiple. Over and above that, the dividend.
That doesn't matter though, because it also depends on where the cash came.
It matters to a lot of investors.
That too, that's true. The per share effect can matter. But all I'm saying is if there's nothing real behind it, at some point in time that per share effect kind of blows up. In fact, at IBM, that's precisely what's happened. Initially, the per share effect kept pushing the price. But at some point in time, people said, well, the value of the business actually is getting smaller. So if, for the short term, I agree with you entirely. And the short term could be years in the making before it catches up with you. Tata Motors, free cash flow to equity of minus 106 million whatever rupees. With the debt, of course, they have a lot more cash flow. They paid out only 75 billion. You see, what do I read into it? Not much, because it's part of a family group. What do family groups do? They just move around income or cash flows. It's not even, I'm not even talking about fraudulent things, which is the old ways these businesses were capitalized was every time a company in the business needed capital, you took a company that was doing well and would invest in the, so it's an internal capital market. The only problem is now we're paying for that internal capital market as investors in these companies. So that's the essence of dividend policy. So that's going to be the last part of what you're doing on your project. Yeah.
Sorry,
Yeah.
can you just go back? Yeah, what's the difference between aggregate and average?
Aggregate, I just add up the 10 years of numbers.
Okay.
Average. So the reason it's especially on percentage numbers, the average can be thrown off by an outlier. So what I often do is take the aggregate to make sure that the outliers are not pulling it out. So this is going to be the last piece of what you do on your project, is you're going to look at the dividend policy of your company, and what that means, compute the yield, the payout ratio. Then try to compute that potential dividend. As I said, it's not difficult to do because you have the statement of cash flow numbers. See whether your company is a company that pays out roughly what it can. It's paying out more than it should or less than it should. Then ask that final question. Do I trust the company with my cash? See, how would I be able to make the judgment? By the time you get to this section of your project, you have all the ammunition you need, right? You got the Jensen's alpha from section 1. You got the return on capital versus cost of capital. So by the time you get here, you have the numbers all lined up. You should be able to make that judgment. And it's a judgment. So I'm going to concede to you that judgment and say, you know, that's what you say based on the numbers. I'm willing to go along. But that's at the core of dividend policies. Now just to complete the dividend section, of course I could have said dividends by looking at everybody else in the game. And as I said, most companies, this is what they do. If you ask them, why do you pay out what you can in dividends? It's what everybody else does. Payout ratio, dividend yields. So if you ask Vale, their defense is, everybody in Brazil does this. So you all go to hell in a handbasket together. What kind of solution is that? But unfortunately, that's again that Me Tooism driving how companies think about dividends. And in fact, in buybacks in the US, I'm afraid that this is the reason. We ask companies, why are you buying back all the stock? There's no, I mean, the good reasons would be, I really don't have projects, I have a lot of cash accumulated. The bad reason is, I don't know, everybody else seems to be doing it. And their prices are going up, therefore, and this is the danger of using the accretion argument, is those guys use that accretion argument. Oh, you know, look, the earnings per share went up, which is actually a surface level rationale for buybacks. Yeah.
One question.
Yeah.
Like, for instance, in Brazil, we don't have many companies that have traded stocks in the same industry. So if you want to compare to comparable companies, could you use global? Because in terms of dividends, the taxation...
I think you have to. The only problem with dividend policies, because of the tax differences, what will end up happening is Vale will compare themselves to Petrobras. So rather than going within the same sector, they're going to compare based on large companies. So you're going to see their comparisons actually change because of the way in which they have to make those decisions, right? At least on dividend policy.
For instance, in my project,
right.
like Natura. Natura is the only company that is traded.
There, I think you have to look at across Latin America, at least in terms of, you know.
But then if there is a difference in taxation,
then that could be the reason why they have a different tax. They don't have to have the same dividend policy. So you'll have the reason then to say, Natura, you know, compared to these 7 other companies, pays far more in dividends, but this is the reason it makes sense for Natura. The tax laws in Brazil are very different from the tax laws everywhere else. So that would be the way you explain why Natura looks different from the other companies.
how would I know the tax law and all that?
So if you're pulling companies from other sectors, then you'd have to search for it. Yeah. Yeah. Yes.
Quick question.
Yeah.
On the decision of paying dividend versus buyback,
right.
buying back. One thing that actually happens in the market is when you buy back stock, you
Yes.
push your price of the stock up because you have to go to the market
There's a liquidity effect.
and buy. But
You know how long liquidity effects last?
it could last enough for your annual goal to be met.
Yeah. So there might be a managerial
And
incentive.
on the other hand, when you pay dividend, your stock goes
And I'll
up.
tell you what adds to this in the US. In the 1990s, how did companies pay managers? What did they?
Stock options.
They paid stock options, right? And you can see how stock options feed this decision.
Yes.
Because every time you pay a dividend with stock options, you're actually making yourself, the manager, worse off. So there is a managerial factor as well. Right? So this is something that's not going to go away. It's a big issue in the US as to what exactly is happening under the surface. And it's an issue that's going to spread across markets because you're going to see companies in other markets going to test the waters and how much they can return. Now, do you want to take a short break? And I have about an hour on valuation. So if you want, I can go through and get it done by 3:35. Right? You guys are hanging out for the... 5 minutes. Let's take a 5-minute break.